After the housing crisis in 2008, it became clear that consumers, and even the mortgage loan officers and brokers, did not fully understand the loan terms of the mortgage transaction before the consumer signed legally binding documentation at closing. Congress made the decision to have the disclosures given to the consumer updated to provide clear information so they could know before they owe. The TILA-RESPA Integrated Disclosure Rule was passed as an amendment to the Truth in Lending Act and replaced the Truth in Lending Disclosure Statement, or TIL, required by the Truth in Lending Act, TILA, and the Good Faith Estimate, or GFE, as required by the Real Estate Settlement Procedures Act, or RESPA. This was replaced with a 3-page document called the Loan Estimate and a 5-page document called the Closing Disclosure. The new disclosures provide more detailed information up front and before the consumer is signing the mortgage documentation at the closing table. TRID is known as the Know Before You Owe rule. The TILA-RESPA Integrated Disclosure Rule, or TRID, applies to mortgage transactions that are both closed-end transactions and secured by real property or a cooperative unit. TRID does not apply to open-end transactions known as home equity lines of credit, or HELOCs. TRID does not apply to reverse mortgages, and TRID does not apply to chattel loans. Closed-end transactions are when the total amount borrowed is given in one lump sum at the beginning, and open-end transactions like HELOCs are those that have a limit. For example, a car loan would be a non-mortgage related example of closed-end credit, and a credit card would be a non-mortgage related example of open-end. A chattel loan is for collateral that is not permanently attached to land. A manufactured home on a temporary foundation would be classified as personal property and not real estate. Congress decided with the TILA-RESPA Integrated Disclosure Rule, or TRID, any time a creditor is required to provide the consumer with a disclosure during the application process, a reasonable time frame for the creditor to send the documentation is 3 business days. Business days for deadlines to send are considered general business days, counting only the days the creditor is open to the public for most of its business functions. The first deadline to send that would trigger the need for the creditor to provide a disclosure within 3 general business days is the loan application. TRID follows the Real Estate Settlement Procedures Act definition of a loan application. This is when the creditor has the consumer's name, social security number, and income, and also the collateral's address, the estimated property value of the collateral, and the loan amount. You can remember what an application is defined as with the acronym ANVILS. The address of the property, the consumer's name, the value of the property, the consumer's income, the loan amount for the transaction, and the consumer's social security number. Just think of all those cartoons where one character is trying to squish another character by dropping a heavy anvil on their head. Luckily, the penalty for missing this deadline is not anvils falling from the sky, but you do have to start the process over since there is no way to cure missing this TRID timing requirement. The creditor is required to send the loan estimate to the consumer within 3 business days of receiving the application orally or in writing. The second deadline for the creditor to provide a disclosure to the consumer is if there is an increase in fees above tolerance and there is a valid reason for the increase. There are 8 different valid reasons for a creditor to increase fees and send an updated disclosure to the consumer. These are known as changed circumstances or triggering events. You can remember these with the acronym EEL and BIRD. Yes, EEL and BIRD are 2 very unlikely friends. If there is a changed circumstance that affects eligibility, the creditor may increase the fees associated with the change and redisclose the increase to the consumer within 3 general business days. For example, if there is a change to the loan-to-value ratio because the appraised value came in lower than the estimated value. The second E is for an extraordinary event beyond the control of the creditor and the consumer. For example, a natural disaster in the area where the collateral is located would be an extraordinary event. So would a title company going out of business mid-transaction. The L in EEL and BIRD is for the loan estimate expiring without receiving an intent to proceed from the applicant. The creditor is required to disclose all fees on the initial loan estimate, and the fees must not change for a minimum of 10 general business days, so the consumer has time to shop around with different creditors. If the consumer takes longer than the 10 business days before orally or in writing letting the creditor know they would like to proceed with the transaction, the creditor may update its fees if anything changed. Note, if the rate is not locked, fees associated with the rate may change, such as discount points. The N is for a changed circumstance that affects settlement charges involving new information. This would be something that pops up later in the loan process that the creditor was not aware of when the initial loan estimate was sent. For example, the appraisal comes back and states the home value is subject to repairs. The B is for a borrower requested change. For example, the borrower would like to increase the loan amount. The I in EEL and BIRD is for a changed circumstance involving inaccurate or changed information. R is for rate lock. The creditor must always disclose a rate lock or rate lock extension, even if the fees do not increase above tolerance, to update the rate lock expiration date and time on page 1 of the loan estimate. The D is for a delayed settlement date on a construction loan. This applies when the settlement date for a construction loan will be more than 60 days beyond the original loan estimate date. A creditor must only redisclose to inform the consumer of an increase in fees if the fees exceed the allowed tolerance. The settlement charges will fall into one of 3 categories for tolerance: 0, 10% cumulative, or no tolerance limitation. The zero category of fees cannot increase at all without a valid triggering event and must be associated with an eel and bird. The 10% cumulative category can increase by up to 10% without redisclosure. If the total fees added together increase by more than 10%, there must be a valid reason for the increase, and the increase must be timely redisclosed. The no tolerance limitation category has no limit for increase. The fees are not in the creditor's control, so they are what they are. The creditor will verify these fees, and redisclosure is not required during the loan process. The fees will be accurately disclosed on the final closing disclosure, known as the CD, at closing. To remember which fees fall into which category, remember the acronym COAT, RR, POPIN. Fees that cannot increase by even 1 penny without a valid triggering event are considered zero tolerance. So the cannot increase fees include the appraisal fee, the credit report fees, flood zone determination fees, and government funding fees or guarantee fees. The O in COAT is for originator fees and credits. These are fees the originator is charging, so they should know how much they are. This includes origination, mortgage broker fees, and general lender credits. Note that a general lender credit cannot decrease because that would mean the total closing costs of the borrower are increasing. A is for any fees associated with an affiliate of the creditor. And the T is for transfer taxes, which are taxes the government charges in association with the transfer of ownership. This is known as conveyance. The RR stands for recording fees, which are the fees the government charges to record a document such as a deed or security instrument. And the creditor's recommended settlement service provider fees. Since the settlement service provider the creditor recommends is not directly in its control, but the creditor should know the fees of the service provider it's recommending to the consumer, there is some wiggle room for an increase in the total of these fees. The fees that are unlimited are POP-in, prepaid interest, collected for a partial month due to the creditor when the loan funds on a day other than the first of the month, has no limitation. If the consumer picks their own settlement service provider, for example, the title company, the consumer should be good with the fees charged since they pick the service provider themselves. Any fees associated with the property taxes and insurance premiums are not in the creditor's control and have no limit for increase. Lastly, any service that was not required by the creditor will be disclosed accurately on the final CD, closing disclosure, but does not require a redisclosure for an increase throughout the loan process. You can remember the acronym COAT RR POPIN is for TRID tolerance with this story. Brr, it's 0 degrees out. I should wear a coat. It should get 10% warmer, but that's still really, really cold. It looks like they have unlimited logs by the fire. I should pop in and say hello. In addition to deadlines for the creditor to send out a disclosure, there are also minimum waiting timeframes, which require the creditor to give time for the consumer to review the documentation sent. The very last loan estimate sent to the consumer is the final loan estimate. The creditor must give the consumer time to review this document before closing. The creditor must wait a minimum of 4 business days from the consumer receiving the final loan estimate before the loan can close. You can think of basketball to remember this. Final 4. The creditor must wait 4 business days from the receipt of the final loan estimate. The second waiting period is the time frame the creditor must give to the consumer to review the initial closing disclosure. The creditor must send the closing disclosure to the consumer and wait a minimum of 3 business days before loan closing. When giving the consumer time to review the disclosures, the amount of time given must be the same for everyone. So the precise business day definition is used for waiting. The Truth in Lending Act defines a precise business day as Monday through Saturday. Sundays and legal public holidays are not included as precise business days. The final closing disclosure is given at the closing table when the consumer becomes the borrower by signing a large packet of closing documentation. Closing is also called consummation, and it finalizes the transaction. There is one additional waiting period, which is the earliest time frame the loan can close. The creditor must not rush the consumer to close. Therefore, the creditor must wait a minimum of 7 precise business days from the beginning to the end. This is considered when they send or provide the initial loan estimate to the consumer, and closing, also known as consummation or the settlement date. If you found this information helpful, please like and subscribe.